In this video we are going to show you the best stochastic trading strategy, along with how to use stochastic indicators. Okay, so what is stochastic indicator? The stochastic indicator is used to predict future trends in a given market. The stochastic indicator is calculated by taking the difference between the current value and the average value over a specified time period. How do stochastic oscillators work? If you place the stochastic oscillator on the chart, you will see two different colored lines, the main line and the signal line. You will also see two key levels, 20 and 80. Ideally, the pair is said to be selling when both lines are below 20 and overbought when the lines are above 80. Find when two lines intersect. One of the ways traders use the stochastic oscillator is to buy when two lines cross the bottom of the stock. Follow the rise until two lines cross the overbought level. A sell signal occurs when two lines cross the overbought level. The signal will appear when the same happens in reverse. How to find the right stochastic oscillator settings for your needs? The first step is to know what you want to measure. This is very important because different stochastic oscillators measure different things. For example, some of them are used for measuring momentum, and others are used for measuring volatility. After identifying the measurement, find the right stochastic oscillator that can measure it. There are many factors that go into choosing the right stochastic oscillator, such as frequency and time frame of price movements, volume and volatility of price movements, and direction of price movements. You should also take into consideration your trading strategy before choosing a stochastic oscillator. The basic trading strategies that work with stochastics. This video is going to be about how to use a stochastic oscillator for trading purposes. A stochastic oscillator is an indicator that shows the current position of the market relative to its recent trading range. It also shows oversold and overbought conditions. Stay tuned, I will show you how to use a stochastic oscillator in your trading and what strategies work best with this indicator. When trading, market participants use two types of valuations. Key indicators look at business information, financial data, and earnings to estimate earnings and other assets. Substitute locations, review diagrams, and use a variety of measurements to support estimates. Our team of traders never sleeps develops the best library of Forex trading ideas. Our mission is to help you transform your trading business. Our favorite time for the best stochastic trading strategy is the 15-minute chart. Indeed, we take the time to evaluate the best stochastic trading strategies. Although the stochastic indicator is a very popular indicator among traders, it has been used in the wrong way. Our team of traders never sleeps.com sets charts and symbols in an unfamiliar way. At the same time, very productive. The stochastic oscillator is an indicator developed by famous trader George Lane in the 1950s. Indicators are used to indicate the direction of relative close value for the highs and lows of a particular time period. Unlike other types of instruments that track volume and price, stochastic oscillators are unique in that they act on the energy of value. This is because price changes before value. Low and high are the lowest and highest at any given time. However, you can adjust this period depending on your activity. Also, like many traders, you don't need to know how to count these numbers. Another thing to note is that there are three types of stochastic oscillators. They are fast, slow, and momentum oscillators. The fast oscillator is based on the first calculation mentioned by Lane. However, the number of %K is a bit skeptical. The slow oscillator eliminates this by removing the key because %K of the slow stochastic oscillator is equal to %D of the speed of the oscillator. We'll show you the results and how to interpret the data from these amazing tools to find out who you're doing business with. If the stochastic moving average is above 80 line, you are in overbought territory. Conversely, if the stochastic moving average is below 20 line, you are in oversold territory. How to keep an eye on the trends? There are many strategies that make good use of the stochastic oscillator. First, make sure that the value of the asset you are studying is trending. This is because the instrument still gives incorrect signals when used in many industries. Second, look at the K and D results. In general, the value of K is usually 14, and the value of D is 3. However, as a trader, you can adapt your data to your business model. We recommend that you find the best placement on a demo account before using it on the real account. Look for overbought and oversold levels. Take the measurements and watch the results. Ideally, a good idea would be to look at overbought and oversold levels. If two lines cross the overbought level, it could be a weak signal. Likewise, breaking through oversold levels can be a sell. However, sometimes two stochastic lines can stay at the overbought level for a while. During this time, the price will increase further. Likewise, sometimes two lines will be at the oversold level when the price is low. So you have to be patient for that. Waiting for the crossing. Another way to use the stochastic oscillator is to wait for the two lines to cross. Find intersections. Finally, you can use a stochastic oscillator to find differences. Divergence occurs when the value of an asset increases when the indicator goes down. When a gap occurs, it is usually a sign of a reversal. 6 steps to day trading with the best stochastic trading tips. Step 1. Check the timeline and make sure the stochastic indicator is below the 20 line and the %K line is above the %D line. We are busy on the same day, but with more time and thought. This is an important part of our strategy because we only want to invest in the direction of more time frames. Our team at TradingStrategySleeps.com has spent a lot of time creating the best information for many trading opportunities, which is key to successful trading. The idea of multiple time frames is important because it provides better readability to current rates and can help you better decide on entry and exit points. Note, on daily charts, the stochastic moving average does not need to be below the 20 levels. They can move away from oversold territory, and the signal is still valid but should not break above the 50 levels. Step 2. Go for 15 minutes, and wait for the measurement result to reach level 20. The green line crosses the red line. This step is similar to the previous rule, but this time we use the rule for a time of 15 minutes. The stochastic indicator rises to the 20 level, and the green line crosses to the red line. A 15-minute recipe is the best time to trade during a day because it's not too fast and not too slow at the same time. The market is said to stay overbought and oversold for longer than traders can stay ready. Therefore, we want to be careful, and this will take you to the next step of using the measurement results. Step 3. Wait for the stochastic %K line, green moving average, to cross 20 levels. We want to do business smarter, right? Well, since %K is a fast average, the %D line will follow, so just wait for level 20 to pass. We don't want to wait too long, because it will reduce your income. Now is the time to focus on the price action that will take you to the next level of the best stochastic trading strategy. Step 4. Wait for the lower swing pattern to appear on the chart for 15 minutes. What is good trading pattern? The lower swing pattern is a 3-bar pattern, and means there is a direction and a bar next to the lower bar. Here's how to identify a swing trade that can increase your money. Here is a diagram of a setup. So far it has been very good, but still does not answer traders' most important questions. This brings us to the next step of the best stochastic trading strategy. Step 5. Enter the buy as it breaks up from the top of the lower swing pattern. Nothing beats illustration. So, after following the rules of the best stochastic trading strategy, the buy signal only occurs after the breakout of the lower swing pattern. Let's go back to the 15-minute chart and see how to use the result measured with a weak swing. So at this point your business is running, and you are benefiting from it. Step 6. Apply stop loss protection under the recent 15-minute low swing. I want to place the stop loss below the current minimum as shown. However, you should not add more than 5 pips from the bottom to protect against breakage. The stochastics oscillator is a momentum indicator that calculates the probability of a security moving in the same direction as the previous trading period. This indicator can be used to identify when a security is overbought or oversold, and when it is likely to reverse direction. Day trading with the best stochastic indicators is the best combination of correct and practical use of stochastic indicators. The success of the best stochastic trading strategies comes from knowing how to read instructions correctly while profiting from the price action. The stochastic oscillator is one of the most popular indicators on the market. It is used to identify overbought and oversold levels. It can also be used to identify differences in the market. To get the most out of it, we recommend that you take the time to try it out in the demo account. This will help you identify the best time to use it. It also helps you develop good business ideas.
Please like, subscribe, and hit that bell button for more videos.